Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Today I'm with Mike Macchiarola from Olden Lane. Mike, how you doing today?
Doing pretty well. Good to be with you, Mark.
Yeah, good to be with you. We've had a couple other podcasts we've done on NCUA's annual plan and perhaps a couple other topics. But today, let's see, earlier this summer or in this summer in August, you wrote an article with Kevin Mietlecki, navigating an opportunity for an NCUA-assisted transaction. And after taking a look at that, it intrigued me that I thought this might be something worthy of chatting with you on the podcast. But before we dive into that, Mike, if you could give a little bit of your background and what Olden Lane does for credit unions for people who may not have heard those previous podcasts that I made reference to.
Sure. Olden Lane at this point is about 7 years old. We originally started because we thought there was an opportunity where credit unions were being underserved, most notably in the capital markets. The first thing we really did was we focused our attention on what was at the time called secondary capital, now called subordinated debt. At the time, I believe it was about $100 million outstanding in that space. Now it's north of $4.5 billion outstanding. And Olden Lane has done more of those transactions as advisor than anyone else in the space by a pretty good margin. We really believe that credit unions could use sub-debt as a growth tool. Up until that point, it was really used for credit unions that were struggling. It was meant as really triage. And used properly as a growth function, it could really accelerate what credit unions were able to do for its members. So we've been very excited to do, well north of $1 billion of transactions in that space. We've taken probably 60 credit unions across the threshold with the regulatory approval required. The space has grown by leaps and bounds. A lot of the complexity that's in that space and some of the newer structures or thoughts originally of our clients and or the folks here at Olden Lane. So we're very proud of that. In about the last year or so, Mark, honestly, a lot of our attention has moved to the M&A space, which we'll get into a subset of that today. But the M&A space is as hot as a pistol, whether it be credit union to credit union merger or the credit union purchase of banks or bank assets. That has been something that obviously in 2024 has been very pronounced. Whether we were lucky or smart, we saw a lot of that coming. We had spent a lot of attention with white papers and thought pieces and internal study to get that business up and running. We now have a full-throated business that can do everything from identifying and screening targets to working on the merger binders for the NCUA and all the regulatory approvals to doing everything required in the valuation suite, both credit union to credit union and credit union to bank. So we're very proud of that. We've built our team out, and that's really an exciting feature of what we can do now. And it builds out a lot of the suite of offerings that we have here.
No, that's great. I know every year since I've started at NCUA, 300 credit unions seem to go away. And it's probably in the 200s now because once the law of large numbers or small numbers, now we're down to between 4,500, 4,600 charters. But it's just the reality of any business that there's going to be mergers. And then with what we've gone through here recently, I think you were smart to see where the puck was going on this, because I think there's going to be an intense period here for a lot of reasons, that whether it's fee income being attacked or loan losses going up, et cetera, it's definitely an arena where that's going to be increasing as a percentage of remaining charters versus decreasing, despite efforts to push things in the other directions, if you will. But so in that regard, the article that I made reference to and NCUA-assisted transactions, of course, there's merger where credit union wants to merge with credit union B, and they both have 12% capital. They're both in the same field of membership, Anytown, USA, and the field membership fits together perfectly. That's one variety.
I've never seen that one. Incidentally, that one doesn't come along all that often. Happy to work on it though.
And we are not here to talk about those simple ones. We're going to talk about one where NCUA might have to kick some money in. And so if you could maybe walk through what you've gleaned from that process and as it relates to this article that you wrote relative to that one particular transactions or other things that you're seeing in this arena recently.
Perfect. The first thing I'd say is we anticipate that we will see more of these on the horizon. And you've alluded to some of the reasons why, but Just to give you a little backdrop, in 2022, there were 6 failures, and those failures cost the NCUA insurance fund $9.8 million, so a touch under 10 million. In 2023, there were 3 failed credit unions that cost the fund 1.2 million. So that trend line's been good, but so far this year, there's going to be more than that. There's more than that we've seen in the market or been working with clients on, including the one that you alluded to with Kevin. But there's a difficult environment out there, as you well know, right? If you just look at the Share Insurance financial report, which comes out every quarter, and I know you look at it intently, more than 10% of our credit unions are now in a CAMEL 3, 4, or 5. I know that's a number that you watch. In the greater than $500 million asset class, CAMEL 4s and 5s tripled. They went from 3 to 9 in the last report, the last quarter. CAMEL 3s are now up to 66 credit unions above $500 million. And when I look at the CAMELs that are 3, 4, or 5 across the whole country, almost 20% of credit unions are now a 3, 4, or 5. That's 879 of that roughly 4,500 base. Number one is, if the NCUA is good at tagging these things, we've got some difficulties ongoing or ahead of us. We can also look at profitability. ROA is at 69 basis points in the last quarter. If I just took out and normalized for COVID and took out the dip that happened when COVID really struck, that's the lowest it's been in the industry for a decade. That's a problem, right? I know we're a not-for-profit, but you need that engine of profitability to be higher than 69 basis points as an industry, certainly. There are 764 credit unions in the country that have a 0 or negative ROA. That's a significant number. You've got 1,300 plus credit unions that aren't earning 25 basis points. And that's a difficult environment, and it really starts to question your go-forward strategy. We've all known what the drivers are. We've got cost of funds that are rising. I think we're a little further along now in the cycle where we're going to start to care about asset quality and the delinquencies. And we've seen that number start to tick up and continue to tick up, and that trend line is troubling. There are good signs, right? NIM hangs in. I think we're probably peaked in the interest rate cycle. But at the same time, you really have to have your wits about you to keep both sides of that balance sheet moving along and maintain your spread. So we're going to see folks struggle. The tech cycle, the regulatory cycle, the fee compression or fee pressure, all of those are going to make it increasingly difficult. And I think it gets more and more difficult as you're down in asset level, simply because you have not picked up the scale to be able to be nimble enough into those headwinds. We see a lot of that coming. Long-winded way of saying more NCUA-assisted mergers on the horizon. Now, why? What is an NCUA-assisted merger? When a credit union decides, or the NCUA decides for them, that it is not going to survive as a going concern, you've got 4 options. You can voluntarily liquidate. You can have an involuntary liquidation. You can have an involuntary liquidation where you have some purchase and assumption behind, or let's focus in on what we want to talk about today, a merger. The first thing to say is, if you get to a place where you have a merger, do it sooner rather than later, because that allows you to have a voluntary merger, which allows for some bilateral negotiation, which allows you to protect the constituencies you should care about. If you get beyond that point, we are now in assisted land where the NCUA has nudged you or pushed you, and you've got a merger where you don't control the terms or the negotiation. So you're already in a place where, as the target or as the merging credit union, it's going to be uncomfortable. And frankly, you waited too long.
Yeah, I totally 100% agree with that. The verbiage I would use at NCUA when I was meeting with credit unions, or my staff was meeting with credit unions, was self-determination, right? At some juncture, you're going to lose that self-determination. And if you're looking for the best fit culture-wise, because culture is very important in the world we live in, it's very important in the credit union industry. Where's the best fit when you still have a little bit of capital before you start Before you go from making 100 basis points to making 50 basis points to making 25 basis points to losing money, to the capital ratio going down, to NCUA. By the way, you mentioned the CAMEL codes deterioration. There's a country western song, "How Can I Miss You If You Won't Go Away?" And NCUA does not go away once you become a code 5 or a code 4. And when you're a code 3, they're there every 6 months. When you're a 2 starting to slip to be a 3, or you're well capitalized, but contemplating being adequately capitalized, and you're sitting down and doing that long-term strategic planning on what's the long-term plan look like, there's just the reality that many of those unprofitable credit unions, you mentioned what's about almost 800 that are losing money, almost 1,300 with 25 basis points or less. They need to look at that and say, okay, what's in the best interest of the membership? What's in the best interest of our staff? How can we best serve our community, our select employee group, et cetera? Because if you can avoid the NCUA assistance arena, you do have that self-determination.
I couldn't have said it any better, Mark. And here's the thing, that when we counsel credit unions that are on this knife's edge, there's so much pride involved. And I get it. We all have pride in what we do, where we work, what our business is. But I want to explain to folks, and I oftentimes I just want to tell them, we've seen it enough times that we know, and we're not fibbing. The world has changed. Things change, needs change. So the world doesn't need a single seg credit union for the purpose of a single seg credit union. There are other places that the members there can find banking. Banking services are available. The nature of banking services has changed. What people demand or want from in terms of convenience or price or deposit level is different. And it's okay if you just can't make it as profitable as you could 5, 10, 15 years ago in a different environment. And I know there's a lot of pride, but you really have to go back to basic fiduciary duty. And you've got to understand, why am I in this chair as either a member of management or a member of a board? And really, I've got to go back to the basics and the foundational principle. And we're going to say, what is in the best interest of members?
Right.
And very often we find ourselves counseling a credit union that is holding on for dear life. And they say, we started as a credit union in Northeast State X, and by gum, we're going to go down. And there's nothing wrong with it. The world's just moved a little bit away from you. And really, your job is to tuck your members in. And very often I will open up, I'll say, okay, give me the credit union near you that you think's doing well, or give me a bigger credit union up the block. And I'll just put the two websites up and I'll say, look at what they have and look at what you have. Let's go through the level on deposits and the level on loans. Let's go for the convenience of a member. Let's go for the branch network. Let's go for the community outreach. The bigger and or the more sophisticated / more efficient is just able to do more very often, and has a lot more levers they can play. And that's okay. And it's sometimes okay to give up your name or your brand. And honestly, again, go back to self-determination. If you make those choices earlier, you can have something to say about how your members are treated, how your staff is protected, how your board of directors has a say in the going forward, how the community investment that you've made may be preserved, or the legacy or the heritage. If you supported an event every year, put a maintenance clause in your merger agreement and make them keep doing it. If you have a set of scholarships, make the acquiring credit union that you can bilaterally negotiate with double that. And then you've made a negotiation and you've done it on your terms, and you've preserved something, rather than let this thing go too long, in which case, as you said, you don't have enough control and the NCUA is going to dictate.
That's a great, yeah, I love those examples, like the scholarship fund, and building into your agreements some things that give you some of what you've been able to build, and make sure that legacy of how you're helping your particular members, as opposed to how they might choose, that you build some of that into those negotiations, which is all okay with NCUA. NCUA is going to ask that, and the merger rules ask that if there's, senior executive staff, or I can't remember exactly how they phrase it, certain staff members, if there's going to be commitments in that regard, that there needs to be things that are disclosed to the members. But as long as that's reasonable, that's something that, that the members will support when they can see all the other things that they may be getting out of the merger. Any thoughts on anything I threw out there?
No, I think you're right. I think there's also for another day, but I think, and this is an issue that a lot of commentators had. Chip Felson beats this one up pretty good. Sometimes in these credit union mergers, there should be more consideration paid than there is. And so the question of a member dividend shouldn't necessarily be driven by a somewhat arbitrary rule at the NCUA when you're above a certain threshold or the distance between the two is at a threshold. Maybe sometimes a credit union should be willing to pay to unlock the equity or the tradition or the heritage and to pay for the inconvenience to the membership of a name change and account numbers and all that has to happen on a merger. I'd love to see where credit unions started to pay significant or real dividends, especially when you look at credit unions that are choosing to merge with banks or do bank deals where they're paying a multiple of the equity to shareholders in those banks. And so they're paying an awful lot of money. And in many cases, it would be easier for them to merge with another credit union. It's just that there are so many frictions around the pride and the personal. And I say all the time, those of us that are bankers in this space, it's incumbent upon us, Olden Lane, myself included, to articulate the value proposition to a potential merging credit union to cutting that deal in this instance before the NCUA gets here and makes you, because it'll be better, but also where it's to your advantage to tuck in your members at an institution that together may be able to do more than either could do separately.
But as you're walking through that with before NCUA makes you do it, a thought just came into my mind. You think you can control that. I'll know when it's time, right? I'll know when NCUA is about to tell me it's time to go away. And that's not the reality of what happens. Sometimes credit unions go from a code 2 to a code 4. They go from a 2 to a 3. They get a letter of understanding and agreement, whether it's a new program or just the reality of the economy in your area hitting you. It's like doing annual physicals, going to the doctor, going to the dentist, getting things done and doing things when it makes sense. If you wait and you wait, you have all that deferred maintenance on how you're taking care of your health. And you think at some point in time, you're just going to be able to pivot. And okay, it's now I've gained 25 pounds. I'm going to go out and run a marathon, right? You're just not going to be able to do that physically. You're not going to be able to do that as a credit union. If you're thinking NCUA will give me some sort of warning when it's time for me to potentially merge, you really need to think it through. You really need to contemplate it, because when NCUA gets aggressive on it, it's too late.
And listen, they have a job to do. They've got 4,000 folks that they have to oversee. They've got a share insurance fund that they're responsible for. And the last thing they are incented to do is wait too long. And we have this issue, which we've written about over here. The way the credit unions are dispersed, there's a significant number of credit unions that are below the $50 or $100 million watermark, like a large number. And when you look at that and you realize those guys that are very big are doing things that are complex that require more regulatory oversight. But at the same time, there are just so many that are small that also require a visit and an exam. It's a very difficult recipe for the NCUA. You start getting this barbell effect where they've got to really have a whole different level of scrutiny for the big guys because they're sophisticated. And then the little guys, there's just a lot of them. And it can get very difficult and unwieldy, both as a regulator and as someone trying to run either of those institutions. The other thing is the world doesn't work on your time. You may have the greatest plan in the world, but things happen and events change. We've had some significant natural disasters, for goodness sakes. They change your business plan immensely and in a second. So you really have to understand and go through these drills. It was good to see the NCUA, for example, go through a succession release. It forces people to think about a lot of issues that they could otherwise get away with not thinking about. And you need to have that rigor in your organization. Frankly, I wrote a comment letter. I wish they had gone further. But it's a start, right? We have to think about all of these things because the risk in an organization like this is multifaceted and very complex.
Great point. Yeah. And the succession planning, I wish they'd done it as guidance. I hope they'll go as guidance. I doubt that'll happen with where the board's taking it. We wrote our first comment letter. I'll probably I haven't really shared it with anybody but NCUA. Mike, I'll send it to you, and I'll probably have a podcast or an article on that coming out as well. But the reality is, a lot of those credit unions, tipping back to what you're saying there, it's we'll evaluate it in 4 years when when I'm ready to retire. Right? That's a lot of people have in their head is they're thinking about their self determination when they want to retire from the credit union. They might not have somebody good in play. And the one thing you might have mentioned it, but that popped into my head too, as well, is with inflation, right? Everything costs more. So to keep your own staff, you have to increase their pay. You might even need additional staff. But the reality is the way your balance sheet is put together isn't allowing for you to do that and keep your profitability up. And I think the inflation thing, so during the exam, you'd always want credit unions to have appropriate expense levels. If someone was above average and they were having challenges, and then you go through the inflation we've had for 2 or 3 years, it's like doubling down on the likelihood of them ever being able to be profitable again or in some reasonable period of time. So,
Yep. The other thing I look at, and I did this a few years ago, I went down to Florida and I was presenting to a large credit union. And the issue I had with them was there was a very large credit union next to them. And I did a series of graphs that showed them if you did better than the very large guy next to you, you're still losing ground because of the compounding effect of an asset level that's already bigger than yours.
sure.
And so when you start looking at it in those terms, and I said, if the credit union next to you just decided they like your CFO because he was really smart or she was really smart and just bid him away or bid her away, you know, you're just going to keep getting attacked. Everybody has to understand that there's risks everywhere and you've got to play with them. You've got to just play every day as hard as you can, understanding what they are and moving. But
Yeah.
you've got to adjust because circumstances change.
They certainly do. They certainly do. So any other thoughts relative to, we've talked a lot about pursuing the merger before, while you still have self-determination on the NCUA-assisted arena, what's the name of where you can sign up to become
Oh, the member
member
registry, merger
thank
partner
you.
registry.
Thank
Yes.
you. Yeah, that came out when I think the first year I was executive director, 2013, 2014, the member registry. And that was because the NCUA board would go to these functions, CUNA's, GAC, and people would say, hey, the credit union down the street merged and I never had an opportunity. And what we would always tell the NCUA board is NCUA is not involved in most mergers. They'll approve it on the back end, but it's credit union A decides to merge with credit union B. The package comes in. Is it safe and sound? Is the field of membership okay? Did they do the vote okay? Boom. NCUA approves. That's how NCUA is involved. The numbers of them, which will be going up as you've described, where NCUA is kicking in money or NCUA is saying you need to merge, are much less. But the NCUA board heard so much about credit unions complaining, saying they didn't invite me to dinner and my board out so that we could merge. How did I miss that opportunity? That's what led to the
Yep.
registry being born. And I'm sure when you're helping credit unions pursue an assisted merger, that comes into play some.
Yes. So the first thing you got to know, you're exactly right. It goes back to 2010, which will tell you,
2010. Okay.
it
Very
goes all
good.
the way back in the Debbie Matz era. The merger partner registry was established by the NCUA. And I tell folks all the time that are in the acquiring side or on the acquiring side, if you think of yourself as an acquirer and you'd like to window shop from time to time, put yourself on that list at the NCUA and you can go on the website and you can find it. And there's a portal and you sign your name up. And they're going to take that information and it creates for them the first batch that they're going to screen or identify of potential acquirers when someone gets in trouble. So let's take, I'm sitting in New Jersey. So a credit union in New Jersey hypothetically gets to where they are not going to make it as a going concern. How does this process work? The NCUA has been in there, they've probably identified them. They've probably ratcheted up their CAMEL's rating over time and everybody's said, all right, it's time. So what happens? The NCUA then says, we're going out and we're going to go to our registry and we're going to look who's in the neighborhood. And it's more than neighborhood now because we have geography is a little different than it used to be because of digital. And so they're going to say, who is in our registry that's a potential acquirer? And potential acquirer really has to have two criteria. Number one, they have to, when we push the two together, they have to survive safety and soundness. They have the ability to absorb financially and operationally the credit union that's being acquired. And then the second thing is compatibility of field of membership. And that second one, depending on how impaired my hypothetical credit union is, that second one kind of has some flexibility. Because in that quote emergency where we're not adequately capitalized, the NCUA can just blow through the field of membership rules and say, public interest dictates. And so we're going to let this one go, even though it's not fully compatible on a field of membership basis. So now the NCUA has identified a pool of potential applicants to be the acquiring credit union. So they go out to those folks and they say, hey, ABC Credit Union, there's someone in your neighborhood that we think would be interesting. They'll give you a rough ballpark to say it's a $100 million credit union. They've come on some tough times, ran into a regulatory hiccup. We think it'd be a decent fit. You want to take a look. If you want to take a look, the price of admission is an NDA with the NCUA. So if you sign that NCUA NDA, you're now under the hood and they're going to put you into a data room. In that data room, you get what's called a bidder's package. You get a summary 20-page, 30-page slide deck from the NCUA, kind of laying out the story. Who's the credit union? What do they have for real estate? How many branches? Why did they fall in a ditch? What's the issue? How big are they? They'll give you some basics on the loan pool and the deposit pool. And then there's more in the data room. You'll probably get all the material contracts. You'll probably get the loan tape and deposit tape. You'll probably get a summary of investments, which includes QSIPs. You'll get a summary of real estate. You probably get a summary, at least an org chart, probably a summary of the staff. You're now in a diligence process. And your diligence process begins with the question that says, do I buy this thing? Or do I bid on this thing or not? That's a fundamental question. And honestly, you're doing it most likely against some time pressure. Depending on the alarm of the fire, is it a 1-alarm fire or a 5-alarm fire? You may have a minute, or you may have a little bit more than that to decide what your bid looks like. And there's a lot of ways, or a couple of ways to structure a bid, and there's some things you should think about here. The first and foremost thing that I would say, even in a small deal, and this is me talking my book, so put every disclaimer you want around it. Please, if I could put one thing through the head of a credit union out there that wants to bid, please hire someone to help you. There's more than meets the eye here. No disrespect to any credit union in this space. I know you can read a balance sheet probably as well, or anybody that I work with here, but we do this all day, every day. We've seen more of these than you have. We know where the bodies are buried. We can read these things and we understand and can bring experts in, including sometimes we would have to go out to someone like Mark and get his expert opinion on how something works or what's going on and the magnitude of the issue at the credit union. Because in most of these cases, there's an issue. It can be as simple as, hey, we're just not profitable for a while and we don't really have a business model that works anymore. Two, we've got some version of fraud, out and out fraud, or a situation that smells like fraud, and we don't even have enough information to decide. So what the professional that you work with can help you with is dialing up the magnitude of that risk. And understanding the magnitude of that risk is fundamental to any bid you're going to make.
That's very well said. They can be plain vanilla, but if NCUA is involved, there's usually some weird issues, whether it's the contracts, whether it's fraud, if there is fraud and that's on the deposit side, what does that mean? If it's fraud and it's on the loan side, what does that mean? And then of course there's the clean merger where you acquire everything, or there's the purchase and assumption where you say, I'm willing to bid, but I only want these assets and I only want these liabilities. By the way, is it going to be an emergency merger? Will the field of membership work? Does it all fit, et cetera, et cetera? So those are great points. If you're looking at one where NCUA is involved, having someone who's been through the ringer before as opposed to it being your first rodeo is really good advice. And one other thing that popped into my head is we're talking about the merger registry. So when I was a regional director back in the day and I had one of these that I needed to shop, I would go, the way it would work is I discuss it with my director of special actions. They'd be meeting with the credit union's board. They would be looking to see who was interested on the registry. Maybe they'd be kicking the can and making some other phone calls. But essentially, on that safety and soundness side, they would be looking at, okay, when you add A plus B, where does the capital land? And there would be some natural cutoff. You don't want to create a bigger problem. You don't want pick 8%, right? Capitalized. Someone's well capitalized. If you add them all together, and it's more complicated now with how the merger accounting works. And then they overlay that with, okay, they're interested in potentially buying someone, but what is their CAMEL code, right? You might be a CAMEL code 1 when you put your name on the list, and you might be a CAMEL code 3 when the opportunity comes up. So the first phase would be special actions taking a look at it. The second phase would be, okay, someone's a code 2, but they got a 3 in management, or they got a 3 in earnings, or someone's a code 3. Could those still stay on the list? Yes, but then you get the supervisory examiner whose examiners coded that credit union a 3. Again, we're talking the surviving credit unions, not the merging credit unions. Might they still be interested? And the less pool NCUA has, the more flexible that they tend to be with who can take them on and what's the definition of unsafe and unsound. Because sometimes I would have conversations with the supervisory examiner at NCUA and they were frustrated for whatever reason, but the world that they were living in and what they were aware of, merging a $100 million credit union into a $300 billion credit union where they were upset about one thing that happened at an exam, shouldn't stop that from being considered in my mind. And that's how I would approach it. So I would sometimes have to push my staff to not be too risk averse in what the definition of safe and sound is. But the reality is you have 14% capital. You've got a better shot at it than if you've got 7% capital. So a good capital ratio that whether you're building it through subordinated debt or natural earnings or a combination of the two, being positioned as the surviving credit union well on capital is a big positive. In addition to those time pressures you talked about, sometimes you only have a minute, and that's because NCUA has someone gets down to 4% capital because of fraud, for example. They're either going to have to merge it within 90 days, I believe it is, under prompt corrective action, or they're going to have to conserve it. Guess what? They don't want to have to conserve it. They'd rather tie it up in a pretty bow, pay you a little bit of money, as opposed to going to the NCUA board and explaining in excruciating detail how they missed that merger or how they missed that fraud. Getting it to go away, conservatorships, their goal is to avoid those. And if they can spend a little bit of the insurance fund money that's reasonable, they'll do that. So that's how that timeline is.
The interesting thing is the NCUA, it would be really fun to see it from the side you saw it from, because the NCUA is charged with finding the lowest cost alternative. And it's not as simple as it sounds, because it's multifaceted. Because it may, as you alluded to, it may cost you in the long run if you tuck this into someone who said, I'll bid in a merger, I don't need any dollars from the NCUA, and I'll take it on. If that turns into a problem 2 years from now where that credit union is impaired, it may be a bigger hit on the fund. As opposed to, how do I weigh that against someone who says, I'll take it on, I'll even take it on in a merger, but you got to pay me $2 million out of the share insurance fund, or you've got to terminate and eat my core contract that costs $750 in breakage.
Sure.
It's not always apples to apples. There's a temporal part of it. There's a risk part of it over time. There are a couple of absolutes, right? Absolute number one, it is very clear that from the NCUA standpoint, they prefer an acquiring credit union to take a merger. Because in a merger versus a purchase and assumption, or P&A, in the merger, the acquiring credit union stands up and says, I take all of the assets and liabilities of the merging credit union, all of their history, any liability known or unknown. Now, that takes a lot to do. And again, not something I would suggest a credit union does without its advisors helping him, because there's a lot of risk you may see. There's a lot of risk you have to be prepared for, that you may not have privy to that information yet because it's not in the data room, or you can't get enough information. It reminds me of the first day I started as a trader on Wall Street. I got a lecture. The lecture was, you need to get comfortable making decisions on incomplete and imperfect information. If you can't get there, you're not a trader, and that's okay. Here is one of those places. In this event, if you're an acquiring credit union and you're bidding, you need to get some level of comfort around making a bid with terms on imperfect information. Some credit unions are very comfortable. Now, what you can do is you can mitigate that risk by learning as much as you can and studying what you've been given. But if you go the merger route, there will always be some, what Rumsfeld called unknown unknowns, right? We just don't know what they are, where they'll come from. And we have to be comfortable that we're big enough, strong enough, resilient enough, and we've studied enough that we don't expect a risk that's too big for us to handle.
I've back in the day when I was on the West Coast as a director of special actions, I can remember one particular situation where the credit union wanted to merge with credit union A. I already knew I had at least one cost-free merger bid in from credit union B, which they didn't want to go with. They'd already invited A in, who was helping them manage the place. And before they put their bid in, they were smart enough to call me and say, can I ask for something? I want to do a P&A. It's just one contract. I don't want it. It might have been the data processing. And the way I framed it up to them yes, they want, their self-determination is they want to go with you. But if I get any other bid that is cost-free and is a merger, who will take that? You will lose. And the guy was like, got it. So he just within an hour, I was sending him some smoke signals, if you will, that careful, you're going to lose this. And NCUA can't do that. Sometimes you can make those calls and say, okay, yeah, there might be a little bit of wiggle room around here. And then also making imperfect decisions. It reminds me of the book Blink, which is how you make a decision in the blink of an eye. And it's really not in the blink of an eye. It's that journey. It's that journey of life that you've taken through, all the things you've seen and done. So you start weighing it in your head, in your brain, and you fill in some of the gaps of the information based on your past history, which actually goes back to get people involved in the process, whoever it is, whether it's Olden Lane or some other consultant that works on these things, is fill up those gaps so you can make the best decision for you. But there are experts out there that have seen more than this. Can, instead of having 75% perfect information, you can take it up to 80, 85, 95% perfect information.
In these instances, my first call is you. And what am I doing? It's exactly what I'm doing, right? I'm saying, Mark has been in that chair. Mark has seen this 35 times. And this may not be exactly something he saw, but it's going to rhyme.
It's going to rhyme.
And the insight I can glean from, you say, yeah, you probably got $1 million or $2 million to play with before the NCUA hits, or hey, they're telling you there's another bidder outside of you, and you're either going to get this straight up merger with no cost or you're not. We could be wrong. I'll bet on your advice in that space, or Olden Lane plus you understanding a situation versus a credit union that's going down it somewhat blind in the first time.
Sure. And an example of that is if you ask for X dollars plus one, it's the NCUA board that decides it. If you ask for an X dollars minus two, it's the Office of Examination of Insurance, and or there's levels that it's just the regional director. And of course, the more hands that touch it in NCUA, the more potentially complicated it can get. So yeah,
we call those off ramps. You try to have a business with fewer off ramps.
Yeah, exactly. Very good. This has been fun. A lot of information here, Mike. If there was one question about mergers or assisted mergers that I should have asked you that I didn't, what might that be?
I don't know. I think you've done a great job. I think we've gotten through sort of everything I thought we needed to say on this call. Again, if I could say really 2 points, one is don't get yourself to the place where the NCUA is dictating terms because your option set is closing. And you owe it to your membership, your staff, your management team, your legacy of your institution, its brand and its community, not to get there, honestly, because if you're going to go out, it's okay. We all have pride again, but it's okay. Do it on your terms. do it in a negotiated setting where you can protect some of those things you care about. And then again, there are professionals here who can help, whether you're in that unassisted setting or you're early and you understand it. And if you don't know where you are on that continuum, we're here to help too. We can, again, we've seen folks in every version of it, waited too long, aren't there yet, have other options, and we can help and assist in any way that's reasonable. We're happy to do it.
That's fantastic. And if someone's listening and they want to reach out to you, what's the best way for them to get in touch?
www.oldenlane.com.
Excellent. All right, Mike, appreciate your time today.
Awesome. Thanks, Mark.
And
Really appreciate it.
listeners, I want to thank you for listening. I hope you'll listen again soon. This is Mark Treichel signing off with Flying Colors.